Yeah, that's right. So this is actually inspired by one of the attendees at the conference, who's also a client and a podcast listener. So I can't remember his name, but he had mentioned that we talk a lot about earnings, we talk a lot about EBITDA, and he just wanted to get a sense of, what was the difference, or rather, which one should he pay attention to more. So I thought that was a good topic, and I figured, I promised him that we would make it a segment on the podcast, and here we go: EBITDA versus earnings for financial analysis. So it is correct. We do discuss EBITDA fairly regularly, as well as, of course, net earnings. Our primary focus is on profitability of a company. If a company is not profitable, we won't recommend it. So profitability is the minimum criteria, and that really just comes down to a business being a really validated, the company actually being a validated business. Like, are you actually able to sell your products and services? Are you able to do this profitably? And we want to see that track record. But what is EBITDA? So EBITDA is a term that, probably a lot of people don't understand. It's a little more esoteric if you're not in the investment industry, or you don't do research on your own. But what it means is this is earnings before interest, taxes, depreciation, and amortization. So you essentially, you would take your revenues, you would take away all of the operating expenses, like the cost of goods sold, rent for any buildings or properties, general selling and administrative expenses, that kind of thing. And that would essentially get you to your EBITDA. Now, the main difference between EBITDA and operating earnings is that EBITDA is before depreciation and amortization. And what this is just an estimate that the company makes in terms of how much the value of their property, plant, and equipment is declining on a yearly basis, right? So you make a big investment, say, in some equipment. Maybe you spend $10 million on that equipment. It's a one-time cost for the most part. But that equipment may only have a useful life of 10 years. So every year they have to take a charge in terms of what they think the decline in value of that equipment is, because one day you're going to have to replace it, and then that charge goes against earnings. But in this case, it does not count for EBITDA. So EBITDA does not consider depreciation and amortization, because it's not an actual cash cost in that given year. And it's also based on an estimate that the company makes. So really what EBITDA is it's a measure of a company's operational profitability. You're not considering the interest expense, you're not considering the income tax expense or the depreciation. You're just looking at the operating profitability of the business, before things that management can control in terms of how much debt they have, or what their estimates are for depreciation, and then, of course, taxes, which is not something that is really operational. It's a cost, of course, you have to incur, but it's not really considered an operational cost. So when you're evaluating a company's operating performance, particularly when you're comparing the company to other companies in the industry, it's often a good idea to use EBITDA, just because different companies will have different capital structures, different level of debt, interest payments, sometimes different tax expense as well. You might have some carry forwards from previous years. You may make some different assumptions and estimates when it comes to depreciation. But EBITDA kind of strips all of that out, so you can just look at that operating profitability. Whereas net earnings is the very bottom line, and this is the profitability after all of the expenses. So this would include charges for depreciation, it would include interest expense, it would include taxes, essentially everything. And really, theoretically, what net earnings is supposed to be is it's supposed to be the profitability that is available for the shareholders after all of the expenses. Now, that's not necessarily in practice totally true. There are a lot of accounting estimates and things that often go into net earnings. We've talked about this on previous podcasts, that a lot of times net earnings aren't a good representation of what the actual profitability, the real economic profitability is. But that's essentially what it's supposed to be. And for some companies, net earnings can be very clean and reliable. For others, you have to make a lot of adjustments, or even just go somewhere else and look at the cash flow. But really, net earnings you're evaluating the company's overall financial performance for investors, and this is commonly used when making an investment decision in terms of how profitable a company is. It's including the operating considerations, and then also the financing and the taxation considerations as well. But really, EBITDA and price to earnings, they're used a lot to compare companies in terms of like how profitable they are, but also they're used in valuation. So how expensive is a business relative to its profitability? And for EBITDA, what you would use is you use an enterprise value or EV to EBITDA ratio. So enterprise value, this is essentially the value of the company when you also consider the debt and the cash, right? So most of the time when you look at a company, like for example, if you were to buy a company and the company were to sell itself to you for, $1 million, a lot of people would say, well, you bought a company for $1 million, but that's not necessarily exactly true. Because what if the company has $10 million in debt? Well, then you're responsible for that debt. So you paid $1 million plus the $10 million you owe, you actually paid $11 million for the company. So, using an EV to EBITDA ratio, it really helps to kind of normalize companies that have very different capital structures, because you could have company A that has no debt and a lot of cash, and that's a completely different capital structure than company B that has a lot of debt and very little cash, right? So you essentially, EV, enterprise value, is the market value of the company plus the net debt. And that is really, if you were to buy the entire company, that is really what the value of the company, really what you're paying, not just the price you pay, but also the debt you incur. So EV to EBITDA is often used when companies are doing acquisitions. It's one of the metrics used. Price to earnings does not consider the capital structure really at all. Different capital structures will have different interest expense, and that will affect in some ways taxation. So it does get factored in there in a way, but when you're doing a price to earnings, you're just looking at the share price, or you're just looking at the market valuation. You're not considering the debt. So this can be misleading, right? Because companies with a lot of debt, they can essentially drive, in many cases, higher earnings by using financial leverage, right? But that comes at a risk that they have higher interest expense, and they have more debt. So there's more financial risk. So if you could have two companies that have the same price to earnings ratio, but one can have a lot of debt and the other can have no debt or even net cash, and that's a very different situation. So just looking at the price to earnings ratio doesn't necessarily tell you anything more about the business. But ultimately, one way to look at the price to earnings ratio is that it's how much you're paying for every dollar of earnings. And then you have to determine what you think a dollar of earnings is worth. If a company is riddled with debt, or it's in a declining industry, or it has other risks, then a dollar of earnings should be worth less than a company that has very little debt, or net cash, or that is in a growth industry, or just in a really better position. So price to earnings will tell you how much you're paying for every dollar of earnings. It will not tell you how much you should be paying for every dollar of earnings. Right. So that they're two ratios that kind of tell you two different things. But just in conclusion, I know a lot of this can be confusing to people. And so I just want to basically kind of sum it up and make it simple. Net earnings and earnings per share, generally, this is going to be the more relevant metric to an investor. As a common stock investor, somebody buying stock in the stock market, it's really the net earnings and the earnings per share that we care about. And we're going to assume that those earnings are right now an accurate representation. If they're not, then we have to understand that as analysts. We have to make certain adjustments. Sometimes we look more closely at the cash flow than the earnings, but you can have a pretty good idea of how messy the earnings are or not if when you're looking at the financial statement. So that's part of being an analyst, is just determining, can we rely on these earnings? But ultimately, net earnings is the profitability that goes to the investor. So that is the more relevant metric. EBITDA, you don't pay dividends with EBITDA. You don't buy back shares with EBITDA. You do that with cash flow, and earnings is supposed to represent the cash flow available for those things. That said, when earnings are messy, sometimes EBITDA is a very convenient ratio to look at because it's less fluctuative. You can compare companies with different capital structures. There's less earnings is lower on the income statement, which means there's a lot of other line items that get in the way, some of which are relevant and some of which aren't. So, EBITDA is also a good metric to look at. And the fact of the matter, and this is the same for other metrics as well, like operating cash flow, free cash flow, you don't have to just use one. So when we talk about EBITDA or we talk about net earnings, it doesn't mean we're not looking at other metrics as well. It's just, especially on the podcast, when we're going over a company, we typically want to do that in a couple of minutes. So it can't be an extremely comprehensive analysis of that company. But, if we're talking about EBITDA of a company, you can be sure that we're also looking at the net earnings or the cash flow and the free cash flow as well. You really want to look at a lot of different things, a lot of different metrics, because each one tells a different story, and it doesn't have to be just one. You really used a lot of them in an analysis. But for the most part, if somebody were to ask me as an investor, what is more important to me, it would be the net earnings, because that is supposed to be what you are investing in as an investor. So that's good. That concludes the breakdown. I hope it wasn't too confusing.
No, it's a good summary.
And that's the thing with just, EBITDA is depreciation and amortization. Again, they're accounting adjustments. Again, it all comes down to, what management and what, I guess, estimates they're using to depreciate, their assets. It really depends. And that's where, it's our jobs as analysts to see if they're actually doing a fair representation of, depreciating their assets over, a fair life of, an asset or what.
And if you look at it from a tax perspective, and this is different than the depreciation on a financial statement, it's actually in management's, they're incentivized to overstate depreciation, because then they pay less tax, because that's an expense. But the tax authorities have completely different rules when it comes to depreciation, and that has nothing to do with what's reported on the financial statements. In Canada, the CRA, and the US, the IRS, they will have their own rules, and then the depreciation that is reported on the financial statement will be different. But some would say for a financial statement, a lot of companies would be incentivized to understate depreciation, because that would inflate their earnings. So it's it's as I said, you can't just look at one thing. You're not just looking at the earnings. You're looking at the earnings in the context of everything else: the operating earnings, the EBITDA, the gross profit margins, the capital structure of the business, the earnings quality, how much of those earnings are actually converting into cash flow, and then other items as well. So.
Yeah, and then it's individual to each business. Is it a software company?
Mm-hmm.
Is it a manufacturing company? Right?
Yep.
All of these things. We wish we could just give you, this is the way you look at every company, and that's it. It's simple.
But then would we be even
analysis
needed?
Is individual? Yeah, analysis is an individual, or is individual to the company or the industry often as well. Mm-hmm. So there's all those things will factor in. But that was a really good summary, and I think it'll answer a lot of questions.
Good.
So
I hope
thank
it helped
you for that.
And if it didn't, let us know.
Yeah, for
I'll
sure.
do another one.
Yeah.
Rip into him.
Or he'll just leave. I'm done. That's what he said. I did enough. That was good. Finally, Brett's going to give us a summary. Or did anybody else have any comments on that? Or we're good? We're good?
No,
I can quickly add something, actually.
Okay.
Cut me off as usual. That's what Brian likes to do. But so EBITDA, companies won't always actually give you, so it normally will require a bit more work. And other times they'll actually provide adjusted EBITDA, which will do a bit more than your interest, your tax, and depreciation. So they'll remove things like, they'll actually add back stock compensation, which we don't like. Lots of the times they'll be doing a ton of stock compensation, and they'll add that back to adjusted EBITDA in this case, which can really inflate it. Other things they will do is acquisition expenses, which are one-off, so you are getting back to that truer operational, which is the point of EBITDA. They'll do foreign exchange, stuff like that. So you really need to pay attention to what EBITDA they're actually giving you, because it's a non-standard metric. It's a non-GAAP metric versus earnings. Lots of times they'll give you GAAP, and then if they adjust it, which they have to give you the GAAP, which is general accounting. What is it? I'm forgetting the actual
generally
acronym.
accepted accounting
principles. Thank you. Yes, I should know that.
So we're IFRS now, actually, but the US is GAAP.
Yeah.
or IFRS.
We were
So
capping
now
that
we're
way.
really confusing.
I know. Forget all these acronyms.
Finance,
but
a
they
bunch
have
of
National
acronyms,
financial reporting
right?
standards, but it's all
Reporting
they're
standards,
basically
yes.
just the accounting standards. And yeah, to your point,
Yeah,
EBITDA is
but my
not.
point.
You can calculate EBITDA technically any way you
Mhm.
want.
Yes,
Um,
that's what Brett was
Yeah.
saying. That's a
That's
good
exactly
point.
my point.
and
Yes.
adjusted EBITDA, you can calculate it any way you want. And I've seen
Mhm.
some calculations almost so egregious where companies were like, "Well, we had a bad quarter,
Yeah.
but if we had a good quarter, and then adjusted EBITDA would have been this." So it's
Exactly.
important more than just the metric. It's important to know what goes into the metric. What was it made up
Exactly.
of? Yeah.
Like even if I could extend the point, like for acquisition expenses, if a company is regularly making acquisitions, as a part of their core growth strategy, that might be questionable if they are adjusting out these.
Yeah, a lot of
integration
companies will
expenses.
pull that out all the time, and they have a 10-year track record of acquiring 30 companies, right? So
Yeah.
that is definitely part of your business, and
It's part of the business.
I get what they're trying to do, but it's if that is your your modus operandi, I don't know if it's good.
Well, and again, you want to look at both, right? Like on one hand, you could make the argument
You
but
can look
that's
at
a
it
growth
both ways,
investment.
yeah.
Yeah, but I mean, I think you can't ignore it. It's the same as Brett said about the share stock-based compensation. If you can look at both metrics. You look at with and without stock-based compensation. If the difference is minimal, maybe it's not worth spending a lot of time worrying about. But if the difference is pretty significant, as we have seen in the technology software space, you can't just ignore it. You don't want to just ignore it.
Yeah, if a company's getting a premium multiple and they're adjusting out that acquisition cost, you want to see how premium it really is without that. Because if the acquisitions are a big part of their growth, if somehow that is removed, then you really don't want them trading at a massive premium. So and again, that comes down to individual for each company, industry, and what they're doing. So not one size fits all, but I think Aaron's overall point is really it should be well taken.